these private credit funds or private equity funds, when they acquire an asset, they might get back leverage. Let's say you acquire a company, you want to finance that with some level of debt. And the way you do that is you'll term finance that. You'll match fund the asset with the term on your debt. So you don't get a margin call. These are all the lessons from the 2008 crisis. The same way when you buy a house, you can get a 30-year fixed rate mortgage because people presumably live in that for a longer period of time. You get an auto loan, the average duration of auto loan is 2 to 5 years because it generally matches the duration, how long you'll be there. You never want to be in a situation where you've got a mismatch between the asset and your financing. If your financing can run away from you and use that to finance your asset, you get a margin call, then you got to cough up your asset potentially at a bad price. Liquidity is called and demanded upon usually the worst possible times of the markets. Buffett, of course, knows this, why he has non-callable permanent financing, and he's borrowing at rates almost as competitive with the U.S. government with AAA debt. Okay, so now here's where it gets more interesting. These private credit issuers, they will be able to generate yield on chain that's meaningful and competitive with the yield you get from when you bank at your local bank, when you make a deposit at your local bank. Okay, so how much yield do you get at your local bank? If you're JPMorgan or Bank of America or the big money center mega banks, not much at all. They can get away with offering zero. Okay, if it's a community bank, they've got to offer yield because they don't have a good product platform experience. They don't have a holistic relationship with you. They've got to track those deposits, and they need those deposits. So these private equity firms are going to start resembling banks in a certain way. They have a direct relationship with the client. They're creating yield for the client, and stablecoins will allow them to create yield-bearing assets that are liquid. That's the key thing. They're liquid. Now, banks are the only institutions that can pull this off in the world, and particularly in the US, because when a bank makes a loan, their deposits, if they run, they're backed by the FDIC. They're also backed by the Federal Reserve. So this is going to open up a new form of competition between generators of yield, providers of yield, the intermediaries of that, and traditional banks and fintechs. So a lot of transformation will happen.